Good morning, everyone. Um, hope you have all begun some of your studying for our midterm, which we're going to have next week. Just wanted to start out by saying that we will be having our midterm next Tuesday, our first midterm next Tuesday. It is going to begin at 10:05, okay, which is our normal class time, and it is going to run for an hour and a half. Okay, we will not be having class afterwards. I'll be including this as an announcement on the announcements for on Blackboarding on the announcements page. But I just wanted you to remember it is on chapters 12, 7, 10, and 9. Okay, and it is going to consist of 30 multiple choice questions. Okay, they are going to be algorithmic. I always have a tough time saying that word. They are going to be algorithmic, so it's going to be different for every person. There will be a couple of maybe up to 10, I would say maximum, theory questions in there as well. Okay, so all right, and so those 4 chapters. After we go over the homework for chapter 9, I'm going to give you just like a brief overview on where you should focus your studying efforts for the midterm. And then if we have any time left after that, we'll be starting the chapter, which is Appendix C. Okay, and again, Appendix C is a tricky chapter. It's on partnerships. And again, just please follow the pages that are mentioned on the syllabus. There are several pages that are in the body of the actual chapter, and then there's a supplement to the chapter also, which you're going to be responsible for, okay, in the accounting for a partnership. All right, so that is how I plan on moving ahead. Okay, last time that we met, our Apple investment, let's check, was selling at $115.10. Today, oh my gosh, very close. Okay, there has been a lot of volatility in the market just because Trump has been saying, okay, he's going to have a stimulus package, he's not going to offer a stimulus package. So there has been some volatility, but here when we look at the price of our Apple investment, it's kind of hung around the same point. Okay, $115.52. Okay, and again, that's post-split, right? We know all about stock splits. All right. If there are no more, and I'm sorry, and the midterm is going to be in a multiple choice format. Okay. All right. So if there are no more questions, we'll continue. And we were doing, we did the first discussion questions for chapter 9. Now here, this is just a basic question about selling an asset. Okay, now remember, chapter 9 was primarily on intangible assets. Here, this is just a quick question on an actual tangible asset. I decided to throw this in on the syllabus as one of the questions to answer. Okay, so, and please remember all these exercises that we're going over within class. Yes, you can see them if you review, listen to the recordings for the class, but I also have posted it under Blackboards in the material section. Okay, so if you just want to look at that by itself, and again, that's a really good prep, okay, for the midterm exam. Okay, the midterm exam is going to have a lot of about 20, I would say, out of the 30 calculation questions. Okay, so make sure you have a calculator. Okay, make sure you get to the midterm on time, 10:05. Okay, all right, I see a couple of questions here. Can you upload? I think I did already, Casey, but I'll check afterwards. Are we going to do a review? Yes, we're going to do a review, Francisco, right after we finish chapter 9. See the grade for the quiz. Denise, you still can't see it? That's so odd. All right, I'll go after class. I'll take a look at it. I'm sorry about that. This weekend, I'll try to make it available, but this weekend I'm going to post those grades to the Blackboard page also for the grades. I'm sorry about that. I thought the other class saw it for some reason. I'm not sure what the setting is. Sorry about that, but thank you for letting me know. I'll take care of that. Okay. All right. So let's just go over this question. Again, this is for a physical asset if you're selling it. Alexander Company purchased a piece of equipment for $14,000 and depreciated it for 3 years over a 5-year estimated life. Okay, so now you guys are all pros at accounting. You know this is an easy question. And it's expected to have a residual value at the end of the 5 years of $2,000. Okay, so at the end of the 3rd year, Alexander decided to upgrade the equipment with increased capacity, so they decided to sell the equipment and buy a replacement piece of equipment. All right, and they sold the original piece of equipment for $7,500. All right, so in this instance, okay, how do we figure out whether that piece of equipment was sold at a gain or a loss? Okay, first thing you're going to do, start with the selling price of the equipment. Okay, that's the amount of cash that they received when they sold this particular piece of machinery. So that's how much the selling price was. All right, now the cost of the equipment, let's calculate. The cost of the equipment was $14,000. And we know at this point that they've depreciated it for $7,200. Okay, and that's because you took the price. Okay, remember basic equation accounting 101. You take the cost of an asset, subtract the residual value, divide by the useful years of life, and that gives you the amount of annual depreciation. Okay, and here, I'm sorry, this is the annual depreciation times 3 because they had depreciated it for 3 years already. Okay, so taking the cost minus the amount of accumulated depreciation. Remember, you have to bring that accumulated depreciation account up to date. All right, and then the difference, the book value. Okay, remember, in accounting speak, then if you, the sales price of the asset, I'm sorry, the cost of the asset minus the accumulated depreciation is always going to equal the book value or the carrying value. Those words are interchangeable. So here, selling price was $7,500. The book value was $6,800. So what was the difference? They had a gain on the sale of $700. Okay, just remember that whenever you have a gain or whenever you record a gain on your books and records, that gain is going to appear on the income statement. Okay, it's really like it's included in the revenue section. Okay, so keep that in mind whenever you're doing any type of calculations regarding assets. Okay, and again, the similar type of calculation could have been made for an intangible asset as well if they decide to sell it. Okay, so that one was a little bit of a review. All right, now, all right, this is a good question, Hunt Company. So Hunt Company is considering purchasing a competing company. Okay, so right away you should think, okay, that could be a goodwill question. They're considering purchasing a competing company in order to expand its market share. Okay, estimates of the excess value of the individual assets, less the liabilities to be assumed, range anywhere from $50,000 to $60,000. Okay, depending on how you do the calculation. Hunt Company, okay, however, believes it can purchase the competitor for the value of the individual assets. And remember, here we're talking about the fair market value of the individual assets, less the liabilities that Hunt has to assume, and they believe they can buy it for $25,000 more than the excess fair market value. Okay, assuming that Hunt makes the purchase for $700,000, at which amount should goodwill be recorded? Okay, and briefly explain your answer. Now remember, when they were doing the calculations originally, they were thinking goodwill could range anywhere from $50,000 to $60,000, typically because that's the amount of, when they did the calculation for the excess earnings. Okay, however, once that's a starting point for negotiations. Okay, Hunt Company was able to basically reduce the amount of goodwill that they were going to pay through negotiation to $25,000. Right, that's going to be the amount then that appears in the intangible asset account for goodwill. All right, so here, according to the answer, goodwill is recorded at $25,000. which was the actual amount paid for, which was the actual amount paid for it, included in the price of $700,000. Okay, this amount is transaction based and therefore it's higher than any objective values. So when they did the analysis, okay, of the excess of the fair market value based on the actual cost, okay, that the company was sold for, they realized they negotiated it and they only paid $25,000. Okay, now whose books and records does that $25,000 appear in? That $25,000 goodwill account. Okay, is it going to be in Hunt's company or in the purchase company? The purchaser, very good, and that's Hunt's company. Okay, very good. All right. Again, goodwill can never be internally generated. Okay, it's the only time it's going to be recorded is when one company buys out the assets and takes on the liabilities of another company. Okay, very good. All right, let's go to the final questions. Let's go to the next one, which is exercise 9A. Okay, so during the past several years, the annual income of Avery Company has averaged about $540,000. At the present time, the company is being offered for sale. All right, now this is the way that I like to trick people on exams. Okay, so look here, you have to read carefully and know your rules. Okay, so in the accounting records, okay, of Avery, the book value of the net assets, okay, which is the total assets minus liabilities, equals $2,800,000. Okay, however, you're also told the fair market value of Avery's net identifiable assets, however, is $3 million. Okay, so in this instance, all right, what is going to be the which figure are we going to use, the $2,800,000 or the $3 million as our basis for determining, very good, the $3 million. We're going to use that basis for determining the amount of goodwill. All right, remember, book value is only for the company that is being acquired. Okay, the purchaser is interested in the fair market value of those net assets. Okay, so an investor negotiating to buy the company offers to pay an amount equal to the fair value for the net identifiable assets, and they're also going to take on the liabilities. In addition, the investor is willing to pay for goodwill an amount equal to the above average earnings for 3 years. So here, they're willing, okay, the acquirer is willing to pay for 3 years of the excess earnings upfront, in addition to the fair market value of the net assets. All right, so on the basis of this agreement, what is the price the purchaser is going to offer? Okay, and you always have to be told, remember, the normal rate of return within that particular industry. Okay, so here, what are we going to do? We are going to start with, we're told in the first sentence that the average earnings for this industry equals $540,000, okay, for this particular industry. I'm sorry, for Avery Company, the average earnings for the last several years has been 540. That's actual earning, average actual earnings. Okay, then we're going to compare the actual earnings to the normal earnings in that industry, which is 15%, okay, of the fair market value of the net assets. Okay, so remember, this is the normal return based on the amount of assets that this company has committed to its operations, which here we're told is $3 million. So 15% of the $3 million equals $450,000. Okay, so again, when we're comparing actual earnings to normal earnings for that industry, we're going to figure out what the difference is, because the difference between those two equals the excess earnings, which is $90,000. Okay, and set up your problem this way for goodwill and you'll have no problem. Okay, and of course there will be some goodwill problems on the exam. So now the purchaser has indicated that they'll pay, as goodwill, they'll pay for 3 years of excess earnings in addition to the fair market value of the assets. We know the fair market value is $3 million. If we multiply the excess earnings by 3, the $90,000 excess earnings times 3, okay, that gives us a total of $270,000. So what is the price that is going to be offered for Avery Company? Okay, and that is going to equal $3,270,000. Okay, everybody got that? Straightforward calculation. Okay, and again, just read carefully, because sometimes it may the way that the goodwill is calculated might be a little bit different. Why times 3? Because that's what the purchaser offered, Lysander, and that's why you have to read carefully. Sometimes what works for some students is they bring a highlighter. Oh no, you can't do a highlighter on a computer, unfortunately, and you can't print the exam. Just read carefully. Here we're told that the investor is willing to pay for goodwill an amount equal to the above, and here, not the average earnings, it's the above average earnings. Okay, so the above average earnings for 3 years, that means the excess of the actual over the normal. Okay. And that's it. All right, so be careful, read carefully as to how the goodwill is going to be calculated, because it could be different in each problem. Just follow the directions. Okay. All right, then if there are no questions, we're going to continue to the next exercise. And the next exercise is from chapter 9. Okay, this is a natural resource question. Okay, so here, Salter Mining purchased the Northern Tier mine for $21 million cash. Okay, and again, when it's natural resources, we're dealing with usually significant dollar values. The mine was estimated to contain 2.5 million tons of ore, and it has a residual value of $1 million. These things will always come up in a natural resource problem. Okay, the residual value and the capacity. Okay, very important points. All right, so during the first year of mining operations at Northern Tier, 50,000 tons of ore were mined, of which 40,000 tons were sold. All right, so they excavated 50,000 tons. Remember, that goes into the inventory account. Okay, and then 40,000 tons of that 50 were actually sold. So again, what else does that mean? If 50,000 tons were mined, 40,000 tons were sold. Okay, what else do we know? 10,000 tons are still sitting in the inventory account, right? For natural resources, it's an unusual situation in that once the resource is mined, that then becomes a current asset, which is inventory, and it appears on the balance sheet as a current asset. Okay, so here, prepare a journal entry to record depletion during the year. So at the end of the year, they're going to make their journal entry. Okay, so now we're told here, what is the calculation? All right, you take the cost of Northern Mine, which is the $21 million. Okay, don't forget you are also going to subtract from that the $1 million residual value. Okay, because they believe they've done engineering estimates. They believe that once they removed all of their minerals from that mine, they're going to be able to sell it to another party for that residual value. Okay, and then they believe also that the capacity for the mine, and you have to be given all of this. Okay, the capacity of the mine is 2,500,000 tons. All right, so the first thing that you are going to always have to determine when you have a natural resource problem is the depletion rate. Okay, and Joshua, I see you have a question. Do you always need? Absolutely. You always need to subtract the residual value in the numerator. Okay, just like any tangible asset, you would always do the same thing. It's just here when you're dealing with natural resources, the residual value is for a much larger value, typically. Okay, and then that's going to give you the depletion rate. Okay, and then that's the rate when the ore is mined Okay, so when you do at year end, when you do your journal entry for the depletion, you're going to take the rate of $8 per ton, and you're going to multiply by the amount that was excavated, which is 50,000 tons. Okay, that's the total that was removed. So look what happens. This is an unusual journal entry because here the 50,000 times 50,000 tons times the $8 per ton, that equals $400,000. So inventory is going to be debited for $400,000, and then what gets credited, credited, and this should be actually indented a little bit. If it's a credit, accumulated depreciation, Northern Tier Mine is credited for the $400,000. Okay, so that's the journal entry to record the amount of depletion at the end of the year. What does, after this journal entry, what does the balance sheet of Northern Tier Mine look like? Remember now, this is the natural resource, the cave, the mining property does appear under plant, property, and equipment because it's used in the operations. So you have the price, okay, of the mining property, which is $21 million. And again, I always use brackets just because you never, when you go back and you review quickly, you won't make a mistake and end up adding it. So here you're going to subtract, just like with if it were a regular long-term physical asset, you would subtract the accumulated depletion from that asset, and then you were going to get the net carrying value or book value of the mine, which equals $20,600,000. Okay. So, and again, when you have a natural resource like this, it's a reclassification problem where it gets reclassified from a long-term intangible asset, okay, and whatever is removed from that mine is going to be reclassified as a current asset you see here as inventory. Okay, so that's why it's very different from regular depreciation. Remember, when you have regular plant, property, and equipment, for normal plant, property, and equipment, for tangible, PP&E, okay, you know that what happens is when you basically deplete the cost over or spread the cost of that long-term asset, such as buildings or equipment, when you're applying the cost of that asset to the operations over its useful life, you know that you are going to use the term depreciation. Okay. So long-term physical assets or tangible assets are depreciated. Okay, when we have things such as intangible assets, okay, that we learned earlier in this chapter, when we're spreading the cost of the intangible asset over its useful life, okay, we know that we are going to use the word amortization. Okay, here now, when we see natural resource questions, okay, and you have to know the difference between these terms. When we're dealing with the use of natural resources, we know the term that we apply, okay, is basically depletion expense. Is the way the cost of this asset is going to be converted to expense over its useful life. Okay, and remember, so these are the three different terms. They really mean the same thing. Okay, you're doing the same thing, but it depends on the underlying asset. Okay, which one of these terms applies? Remember also that when we were studying chapter 10 and we were looking at bonds payable, remember bonds payable, if they're issued at a premium or a discount, remember those premiums and discounts are going to be amortized as well. Okay, so know how to use those terms and know what the definitions are because it's very specific. okay, to the underlying asset or debt. Okay. All right, good. So then there were some other questions here. Okay, so saltier mines. So question B. Okay, so question B said, how does this appear? How does a saltier mine appear under the plant and property and equipment section on the balance sheet? It's always going to be the cost of the mine less the accumulated depletion. Okay. Then letter C was, okay. Will the entire amount of depletion? Okay, this is a good question, guys. So pay attention. Okay. Will the entire amount of depletion computed in Part A, okay, this $400,000, will it be deducted from revenue on the income statement for this year? Okay. And the answer is, of course, no. Very good, Lysander. What amount, Lysander, is going to appear as the on the income statement? How would you calculate that? What's the
Would it be the cost, the expenses?
very good. And again, specifically that when you're selling inventory, what is the expense? Cost of goods sold.
Yeah, yeah.
Okay, very good. So here, what did we do? Basically, what appears on the income statement for that year? Basically, we're going to take the 40,000 tons, okay, that were sold that year, not 50,000. Remember, they only sold 40,000. So the 40,000 tons times the depletion rate, which is $8 per ton. So the amount of cost of goods sold that we're going to see appearing on the income statement, okay, equals $320,000. Okay, so $320,000 is going to appear as the cost of goods sold. Okay, and which amount then, what account is credited and for how much then? Okay, what's the second part of this journal entry? You debit cost of goods sold when you sold the goods. Okay.
I meant to say sales debited.
Not yet, not yet, because there's remember
Sorry, accounts receivable debited.
Nope. Yeah, okay, so all right, so you're going for the other journal entry. Okay, very good. For the
credited will be sales.
Yes, very good. So here we are, the second journal entry under the perpetual inventory system. We don't know how much they sold it for, but the accounts receivable is going to be debited and sales, very good, Lysander, is going to be credited. But here, don't get these two confused, okay? That's to record the actual sales price for the inventory, okay? But the second journal entry, we're going to debit the cost of goods sold again, and again, that's for the depletion rate, and credit, very good, Christian, we're to credit the inventory account. We're reducing the inventory, excellent. Okay, and remember the inventory and the cost of goods sold is always based on the original cost, which was the depletion rate. Okay, just remember, don't intermix those two journal entries. It's very easy to do. These are two separate, and these two accounts have to be together. Cost of goods sold debited, inventory credited for the depletion rate times the number of tons that were sold. Okay, and then here they tell us what the price that was sold for, but we would also, the second journal entry would be a debit to accounts receivable and a credit to sales. Very good. Okay, then if I asked you, okay, so I'm going to give you, I don't think that's the next question. Okay, so here, what if I asked you, okay, now after I do these two journal entries, okay, which basically record the sale, okay, what's the remaining amount in the inventory account as of 12/31 on the first year? What is the inventory account? Does it have a zero balance? No, very good, Christian. What's the balance? Matthew Lysander. No, not 10 million. How would I figure out what the balance? Yes, very good, Mark. $80,000. I would take the very good, Kristen. Remember, take the amount, the $40,000. okay, which is, or no, I'm sorry, is it $40,000? No, the $400,000, okay, the $400,000, very good, which is the amount that was debited here to the inventory account. $400,000 was debited to the inventory account when, that's okay, when that natural resource was mined. And we know we sold, okay, or $320,000, okay, or 40,000 tons. All right, so what's the remaining amount in the inventory account then? It's going to equal $80,000. So we could always calculate that. Okay, very good. All right, so just be familiar with all of those calculations. Okay. So the second question, no, will the entire amount of depletion be recorded, be deducted from revenue? And the answer is no. In this year, only the $320,000 will be deducted against revenue. The remaining $80,000 is sitting in that current asset account, which is inventory. Okay. And then letter D, what is the journal entry? Okay, so this is really important. Okay, so this journal entry here, all right, in letter A, what does this journal entry do to the current ratio? Okay, so again, going back to your Accounting 101 class, you remember the current ratio was current assets divided by current liabilities. Okay, so what's happening here when we look at this first journal entry here? When we debit the inventory account and we credit accumulated depletion, okay, what's happening here in terms of the accounts on the balance sheet is that the current assets are increasing, right? Whenever we increase inventory, our current assets are increasing, and we're decreasing our long-term assets. Okay, so if the question asks, what does this journal entry do to the current ratio? Okay, since the numerator, the current assets, is increasing with this journal entry, that means the current ratio is going to be increasing as well. Okay, and again, what happens when that ore is extracted? It makes the company more liquid. Okay, because the inventory account is more liquid or closer to cash than the plant, property, and equipment, or the mining property was. Okay, so that's why the current ratio would increase also. Okay, so this is really a reclassifying journal entry. Okay, based on what was removed from the mine, or could be, again, it could be a forest, it could be anything, any natural resource. Okay, everybody good? Let me see, is that it? Okay, that's it, okay, for this particular chapter. All right. So let me give you a little bit of an outline for the midterm. Okay, let me pull up a blank screen. All right. So as I mentioned, there are going to be 30 multiple choice questions. Bring your calculators, okay? All right, oops. 30. All right, you'll have an option of 4 different answers. It's going to be on chapters 12. What was it? 12, 10, 7, and 9. 12, 7, 10, and 9. Okay. All right. So what do you need to know? All right. From the first chapter, all right, when we were dealing with chapter 12, there was a lot of different information in that chapter. What I would suggest that you do, again, I would put together an outline, especially for that particular chapter, because there was so much information. But for chapter 12, I would be very familiar with earnings per share. Okay, we went over that a lot, and we dealt with several earnings per share. Okay, we dealt with simple earnings per share when there's a simple structure. Another way that we calculate earnings per share is the weighted average earnings per share. Okay, and we use the weighted average earnings per share basically whenever the number of shares that were outstanding over the course of this year changed. Okay, and then we would have to attach a weight to whatever, to the time period that those shares were outstanding. Okay, to figure out what the weighted average number of shares were. Okay, again, another earnings per share figure that you must be able to calculate is what happens when there is preferred stock outstanding. Okay, remember when there is preferred stock outstanding, okay, the amount of the dividend on that preferred stock issue, only if it's cumulative, okay, only cumulative stock dividends must be recorded, or I'm sorry, must be subtracted from the net income, okay, from the numerator of the calculation for earnings per share. Remember, the simple earnings per share calculation is you're going to take what the net income is for this corporation, and you're going to divide again only by the number of common shares outstanding. Okay, so earnings per share really is only calculated for the common shares. Okay, if there's no preferred stock outstanding, then you don't have to do, it's either the simple formula or the weighted average formula. Okay, when there is preferred stock outstanding and it's cumulative preferred stock. Okay, and you always have to be told which type of preferred stock is outstanding. If there's cumulative preferred stock, the amount of that dividend, okay, must be, the cumulative dividend must be subtracted. Okay, and remember, it doesn't matter. It doesn't matter if that cumulative dividend has not been paid for several years. Okay, it's only the cumulative dividends for the current year which is subtracted. Cumulative with the current year only. Again, what happens if it's non-cumulative? Okay, who remembers, if it's non-cumulative preferred stock, what happens with that dividend if it is not paid, let's say, for the last 5 years? How would that be incorporated in the earnings per share calculation if it's non-cumulative stock? Anybody remember? Come on, guys. Depreciates. Oh my God, thud. No. Yes, exactly, Christian. Very good, Mark. Right, very good, Kristen. If it's non-cumulative preferred stock, that dividend would not be subtracted then. Okay, because the corporation is not liable. Okay, if it's non-cumulative stock. Exactly. Okay, it's only in the year that it's declared. If it's non-cumulative, so therefore it's not going to be subtracted. Very good. It can be ignored. So make sure you read carefully. Okay. All right, so we need earnings per share for simple, weighted average. We need to subtract the dividends if it's cumulative preferred stock. And the fourth one is fully diluted earnings per share. Okay, remember, fully diluted earnings per share only comes up, okay, only affects our calculation if there are convertible securities. Okay, fully diluted only that comes up if there are convertible securities outstanding. Okay, so this fully diluted is an as if or a pro forma calculation, and it states again, even if the convertible security holders did not trade in all of their convertible securities, but we must do a calculation as to what the effect on earnings per share would have been had they converted all their convertible securities. Okay, so what would change if there's convertible securities? The number of common shares outstanding would increase. Okay. And again, if there are no convertible securities, there is no, you don't have to do the fully diluted earnings per share. You just have to do the symbol. Okay, this is a very important calculation for the exam. Okay, I would know all of these very well. Let's see what else. Okay. Chapter 12. Again, another issue that was addressed in Chapter 12 is the income from discontinued operations. Okay, and discontinued operations basically comes up when a company disposes of a full segment of its business. Okay, so it's Boeing selling off its helicopter division. It's not Boeing selling off a couple of its helicopters. Okay, so income from continuing operations, this must be reported separately on the income statement. Okay, remember that there are two bits of information that have to be reported when there's income from continuing operations. Basically, the gain or loss. Can you update? Yes, I'll do it right after class. Just if you could remind me at the end of class, and I'll post that too. So again, for income from discontinued operations, it's the gain or loss. Okay, to date. All right, so basically the gain or loss to date in the operations, net of the taxes. Okay, so remember the figures that are reported for income from continuing operations must be reported net of taxes. Okay, prior to disposal. Excellent, Kristen. Exactly. Your loss to date. Very good. So prior to the disposal, and take into account the tax effect. And then what's the second bit of information? Gain or loss to date, and then again, it's going to be the gain or loss on what? Or loss. Very good. On sale of the assets of disposed division. Also, okay, don't forget, also net of the tax effect. Okay, because remember that in the continuing operations section, which is the first section on the income statement, remember that those amounts are shown originally. They're shown at the gross values. Okay, then though, the last line of the continuing operations section is a deduction for the taxes. Okay, for the income taxes. So since the continuing operations section is net of the tax effect, the income from the discontinued operations section is going to be net of the tax effect also. And remember, okay, remember also that income from continuing operations, we are going to see the earnings per share figure being subtracted from there as well. Okay. Josh, how does the net of tax effect apply to a calculation with discontinued operations in the journal entry? Can we do an example? Okay, so let's say, all right, so let's say there was a gain, okay, on the operations of this business. They had 100,000 gain this year, okay, prior to the sale of the division. Okay, and let's say they're at a 30% tax rate. Okay, so if there's a 30% tax rate, all right, use the reciprocal amount. We're going to now multiply that 30% tax rate. What is the net after tax effect? We can multiply it by the reciprocal, which is 0.70. All right, so which is what then that 100,000 gain. What does that $100,000 gain equal after taking into consideration the tax ramifications? It's going to equal the gain on the sale of the assets is actually going to equal $70,000. Okay. Another way you could have done it, okay, is take the $100,000 gain, okay, on the sale of the assets. You can multiply it by 0.30, which is the tax rate. Okay, subtract that $30,000 from the because remember that $30,000 represents the tax expense. Okay, when you have a gain, you have to pay taxes on that gain. So here, you could have just subtracted the $30,000 taxes, income taxes on that $100,000 gain to give you a net gain on the sale of operations of $70,000. All right, and you would do the same thing for the gain or loss on the sale of the assets. But you always have to provide the net effect after you consideration what the tax effect was. So always multiply by the tax rate minus tax rate. Give the always multiply by the reciprocal. So the easiest way to do it is to multiply by the reciprocal of the tax rate. So 1 minus the 30% tax rate equals 70%. Okay, and if it's easier for you just to do the two steps, whatever is easier for you. Okay, but remember also that the gain or the loss on the second calculation is also going to be net of the tax effects. Okay. All right, so again, in chapter 12, we went over discontinued operations. Another issue that came up in chapter 12, okay, was what happens when there is an unusual or infrequent item, infrequent event that occurs. Okay, remember that when there is an unusual or an infrequent event, okay, who remembers how that's reported on the income statement? An unusual or infrequent event. Where does it appear on the income statement? Okay, and how does it appear? Anybody remember? An unusual or infrequent event. Okay, remember, and again, that's like, let's say, an earthquake in an area that really doesn't have that type of activity, or if, let's say, oil is discovered on one of the properties and it hadn't been anticipated, there was some type of gain, some type of loss. If there's an unusual or infrequent event, okay, and again, it can be a gain or a loss. Right, it is going to be excellent, Christian. It's shown under the continuing operations section, which is the top section of the income statement. Very good. Okay, it's considered in the continuing operations section, and again, how does it get recorded? It must be reported as a separate line item. Okay, so any unusual or infrequent events, it is going to be reported under continuing operations. However, it's going to be shown, it must be itemized in a separate line item. It cannot just be included, buried in the cost of goods sold. Okay, it has to be identified specifically. All right. Again, and why do we bother with this income from continuing operations? Why do we do the different sections? Basically, it's because if you are an investor, okay, or if you are a creditor in this particular corporation, which section would you be the most interested in? You would be a creditor or investor. Very good, Joshua, in the continuing operations section. Okay, because you want to know. Okay, so they ended up disposing of some of their segments. That's not going to affect the future operations. So when you do your calculations, you would focus more on the continuing operations as a potential or existing creditor or investor. Okay, so keep that in mind. That's a very important point. That's why we go through all of this information, itemizing, updating the basic income statement, which you had learned earlier. Okay. All right, everybody has the information here. All right, the next thing we are going to the next chapter that we talked about was chapter 7. Okay, remember that chapter 7 was that chapter on available for sale marketable securities. Okay, remember the available for sale marketable for securities. Okay, this type of asset, okay, available for sale securities. These securities basically defy one of the basic concepts that we learned in accounting, and that basically is, remember, it violates the cost principle. Okay, the cost principle, what we've always basically valued securities at is the cost. Okay, now with available for sale marketable securities, they are considered so close to cash. Again, remember, they are going to appear directly below the cash line. They are considered so close to cash that what happens is that there's going to be, each and every year, there is going to be an end of year valuation. Okay, which is going to adjust for changes in the market value of these securities. Okay, so again, it's each and every year there's going to be a valuation to adjust for the changes in the market value, and that means that the value of these securities can actually be increased, okay, above what their cost was. Okay, remember though, okay, that these gains or losses that are recognized at year end are only recognized gains or losses. Okay, they are not realized. Okay, so what does that basically mean? It means that they do not appear on the income statement. Very unusual situation where you see this revaluation occurring. Again, it's a recognized gain or loss, but it does not appear on the income statement. They are not realized gains or losses. Okay, and again, how are we going to value this? Basically, what happens is that if the market value is higher, okay, if the market value is higher at year end, and again, that's if the market value is higher than cost. Then the cost at year end. Okay. What is the journal entry going to be? If the market value of these highly liquid marketable securities is higher than what the cost was, okay, during the course of the year. Again, they haven't been sold. We still own these securities. Okay, what is the journal entry? The marketable securities account would be debited. Okay, the marketable securities account would be debited. And then what account would be credited? If the market value of these securities is higher at the year than the cost, which account is credited at year end? Hello? Anybody remember? Remember, participation does count. Debit marketable securities, credit what? Unrealized gain on marketable securities. Okay, and yes, Lysander, that is an equity account. Okay, this unrealized gain on marketable securities, yes, it's an equity account. That means that it is going to appear under shareholder equity, and if it's being credited, that means that it's increasing the amount of shareholder equity. Very good. Okay. And again, this increases. And the reason, and remember, the reason that it appears here is because since the corporation still owns these securities, it's not a realized gain, okay, but it is a recognized gain, so it appears on the balance sheet. Okay, so let's take the flip side. Let's say that now the market value is higher. I'm sorry, the market value of these securities okay, when they are assessed, and it's going to be at the end of every year, if the market value of the securities is lower, okay, than the cost, okay, of the securities when they are purchased, what is that journal entry going to be? That journal entry then is going to be a debit to unrealized. Let's make it even more specific. Unrealized holding gain. Let's throw that word in there. Unrealized holding loss in this instance on marketable securities. Unrealized holding loss on marketable securities would be debited, and then what gets credited? The marketable securities account. Okay, so this is the assessment that must take place at the end of each and every year. Remember that when the corporation is buying these available for sale marketable securities, the intent, okay, when the corporation buys these securities, and again, these securities can be stocks or they can be bonds, right? The intent, however, when the corporation buys these stocks or bonds is that they believe they're going to be selling these securities within the next 12-month period. They have no interest, and they have no interest in the controlling interest in those corporations they're buying these stocks or bonds in, okay, and they have no long-term commitment. They just have extra cash. Okay, they don't want to leave it idle and or uninvested. So what do? The corporations then invest in these available for sale marketable securities. Okay, we saw that the dollar value actually of these securities can be substantial. Okay, a lot of corporations keep a large cash balance on hand. Okay, so these could be large portfolios that they have. All right, but the intent again is to sell, in the short term. In the short term. Okay. Let me see, anything else for that particular chapter? I think that's about it. So just be very familiar with the journal entries, what this actually means, how it's recorded, how it's reflected, these changes. Okay, remember that if the price of marketable securities changes and you're debiting it here, okay, or you're crediting it here if the value has decreased, remember that calculation, the cost of the marketable securities, will always be shown on the balance sheet first. So you would show the cost of the original securities, then you would show the deduction if the value of these securities decreased over this particular year, or if it increased over this year. Remember this assessment, okay, and this adjusting journal entry that we're talking about for marketable securities is only made once a year. Okay? All right. All right. Another chapter that we dealt with, and again, we had the quiz on this chapter. I'm going to take a look at this, take a look at the settings for the quiz also. And that is, I'm going to erase this now. The next chapter that we looked at was chapter 10, and that was on bonds payable. Okay, remember, bonds payable was a tricky chapter. All right, there was a lot of information there, very different. Okay, so when you're approaching, advice, when you're approaching the midterm, when you start looking at the questions, immediately think, okay, which chapter is covered? Does this particular issue, which chapter is it covered in? Okay, that'll help you organize your thoughts. All right, so bonds payable, remember these are, this is debt. Okay, that is basically sold by the corporation to its bondholders. Okay, remember these bonds are sold on a public exchange, just like stocks. Okay, again, what is one of the biggest benefits? Why would a corporation opt to issue bonds, which is debt financing, as opposed to selling stock? Okay, remember that interest paid on bonds is tax deductible. Okay, so interest paid on bonds is tax deductible. Okay, remember though that when you have bonds have to ultimately be, bonds payable must ultimately be paid back upon maturity. Okay, remember that if a corporation has equity outstanding or stock doesn't have to be paid back. Okay, stock has an infinite life. Also, just realize that a corporation, typically a large corporation, has a blend of stock and debt financing. Okay, and that's something that the financiers, those of you who are future financiers, that's something that you would be looking at in your future jobs or careers, possibly. Okay, bonds must be paid back. Okay, what you're going to say. Remember, the amount that is credited to the bonds payable account whenever bonds are sold. The bonds payable amount, the first journal entry that you're going to do, bonds payable is going to be credited for the face value of the debt. Okay, so whenever you're in doubt, that's what you're going to start with on the date that the bonds are sold. Okay, and also upon their maturity date. Remember that there's about 4 different prices that a bond can be sold at. Okay, and you're responsible for knowing all of these. We spent a lot of time in it. Bonds can be sold at their face value. That's what you pray for on an exam. That's the easiest ones. That's the easiest one to calculate. Bonds can also be sold with accrued interest. Okay, so bonds can be sold with interest that has accrued since the last interest payment date. Okay, and remember in that particular instance, when that happens, all right, what does the issuing corporation have to do? If the bonds were sold between interest payment dates, when those bonds are sold, I'm the issuing corporation. I'm going to require you, the bondholders, not only to give me the principal amount of that debt. Okay, I am also going to require that you give me any interest, okay, that has accrued since that first interest payment date, or since the date that interest will be paid on, the first interest payment date. I'm going to have you pay me for that accrued interest. And then on the first interest payment date, I am going to pay that amount of accrued interest back to you. Okay, so face value, bonds could also be sold with accrued interest since the last interest payment period. Bonds can also be sold at a premium. Okay, and bonds could also be sold at a discount. Okay, so then you just have to know all of the calculations, how I would record, again, how you record on the date of sale. Okay, the journal entries on the date of sale under each of these 4 different scenarios, and then also the journal entries that are recorded over the life of these bonds. Okay, and now Joshua, bonds can be sold at a premium, which is above 100, very good, and they could be, or they're sold at a discount, which means they're sold at a fraction below 100, like 99, 98, etc. Okay, all right, remember that, and again, all those calculations, all the homework that we went over, remember if bonds are sold at a premium, okay, what does a premium do to the effective interest rate? Okay, if bonds are sold at a premium, that premium lowers the effective interest rate. Very good. Remember, if bonds are sold at a discount, basically, if bonds are sold at a discount, we know that that discount raises the effective interest rate. Okay, and all of the journal entries, okay? So remember the 4 dates, if I were going over, what are the 4 dates in the life of a bond that you have to be familiar with? You have to know what happens, the journal entry on the issue date. Okay, the journal entries that happen on the interest payment date. NTR, and interest payment dates. Okay, the tricky one, okay, and don't forget this here, very good, Kristen. When at year end, remember that at year end, interest must be accrued. At year end, interest accrual. Okay, and then finally the last, important date in the life of a bond is on the date of maturity. Okay, so remember those 4 dates, remember the different prices before you attack any of these bonds, payables problems. Sort out in your mind, okay, which issue are we dealing with here? Okay, which of the 4 bond pricing scenarios are we talking about? And then go through the particular dates. Okay, remember, okay, that when a bond is sold at a premium or a discount, okay, remember discounts and premiums on a bond must be amortized. Okay, over the life of that bond. Okay, very important, and how that affects the journal entries. All right. Remember when you're amortizing, okay, remember that bond discounts, when they are first recorded, discounts have a debit balance. Okay, so when you're amortizing a bond discount, you know you're going to have to do the opposite, which is a credit. Okay, this is the way I always remember it, just okay in my mind how to do the journal entry. Good way just to check, to double check. Remember that when on the date of issue, premiums are typically credited, okay, in that journal entry. So when you're reversing, okay, a premium, as you're amortizing it over its useful life, what are you going, premiums are, oops, I was just testing you. Oh, yes, so I'm sorry. So on the date of issue, here, let me get a little specific here. So on the date of issue, you know that discounts are going to be debited. Okay, so over the life of the bond, as you're amortizing a discount, you're going to do the opposite. You're going to always credit the discount as you're amortizing it. Okay, remember that when you're first recording a premiums are typically going to have a credit balance, are always going to have a credit balance on the date of issue. Okay, so when you're amortizing, okay, when I'm amortizing a premium, okay, what am I going to do with that premium on bonds payable as I'm amortizing it over useful life? As I'm reducing that premium, I'm going to debit it. Very good. Always the opposite, very good, Christian, of the existing balance. Okay. Remember the formula again for, and these are all calculations that are going to come up, okay, on the exam. Remember that when you're figuring out how much of a discount is going to be amortized, the amount of discount for each 6-month period, and again, it could be a discount or premium, you're going to take the total amount of the discount or the premium, okay, and what are you going to divide by? The discount or the premium. When you figure out each semi-annual amount, you're going to multiply by the years of life times, it could be 40, but remember, Casey, it doesn't have to be 40. Yes, not year times par, you're close. The number of years of life, remember, par is for stocks, times 2. Very good, Christian, times 2. Since we have different, there's always 2 interest payments. That's okay, Kristen. It's good that you got it here. That's fine. Okay, you're better off straightening it out here. That's why we're doing the review. It's the years of life. And again, the years of life of a bond can go, it can be 20, it can be 40. That, I think our examples always dealt with 20 years of life, so it was 40 interest payments. It doesn't have to be that, though. Okay, it's always the life of the bond exactly times 2. The number of years of the bond's life times 2. Okay, so it doesn't have to be 20. Okay, it can be whatever it is. So it's specific to the problem. All right. Let me see. All right, and then the last chapter then, pretty used, very good, yes. But remember, thank you, Lysander, but remember that it doesn't have to be that. Okay, it doesn't have to be 20 though. The last chapter we're going to be looking at then is the last chapter that we had, which is chapter 9. Okay, and chapter 9 dealt with the intangible assets. Intangible assets and also natural resources. Okay. Intangible assets are any assets, typically they're legally protected rights that the corporation has. Okay, it's not a physical asset when we're talking about intangible assets, like equipment, a building, land, something of that nature. All right, but it does bring a future benefit to the corporation. Okay, remember the trickiest intangible asset in terms of valuation was goodwill. Okay, refer to the homeworks that we went over earlier today for assessing goodwill. Remember that goodwill is recorded at cost. Okay, but remember goodwill only gets recorded when one corporation buys out another corporation. Okay, that's the only time that it could be recorded. There's no such thing as internally generated goodwill. Goodwill is recorded at cost, at the price. Dante, basically at cost means whatever the price is that the corporation pays. Okay, and I'll go over the specific definition in one moment. Remember, goodwill is only incurred when the corporation buys out another corporation. And again, what is the cost of goodwill? Not the cost of the business. Nope. Remember, goodwill relates to the excess amount paid for the business in excess of the fair market value of the net assets. Fair market value of the net assets. Okay. Of the business that it's being purchased. Yes, exactly. So you don't always have to be told that. And remember, it's the fair market value, all right, not the book value. Okay. Fair market value of the net access. Any excess that is paid is going to be debited to the intangible asset account. Remember, intangible assets have that separate section on the balance sheet, really the last section under the assets. Remember what has to happen annually or at year end, okay, is that goodwill must be tested for impairment. Okay, and the adjusting journal entry is going to be recorded if the purchaser believes that at year end the original amount that was recorded as goodwill no longer exists. Okay, remember that amount of goodwill is never going to be increased. Okay, it can only be tested for impairment and reduced because of that impairment. Okay, remember all the other intangible assets, okay, that we talked about. Some of them, again, were patents, copyrights, patents, copyrights, franchises. With just a couple of them. Remember, they are always recorded at cost. Okay, and again, they're recorded at cost typically when they are purchased from an outside party. Okay, so typically, if it's an internally developed franchise, a copyright, the expenses that were incurred with regard to developing those intangible assets are just charged to expense in the year that they are incurred. Okay, so typically you're only going to record a patent, the copyright, etc., if it has been purchased from an outside party, because then the cost is going to be substantial. Okay, then what happens with patent or copyright? It is going to be amortized. Okay, the cost of that patent or copyright is going to be amortized over its useful life. Useful life or legal life, whichever is lesser. Okay. Patent, copyrights, franchises. Okay. All right. So that, and then the last bit of information that we went over in Chapter 9 was for the natural resources. Remember, just because it's included in this chapter, okay, does not mean that a natural resource is an intangible asset. A natural resource appears as part of plant, property, and equipment. Okay, an asset, and we know use today's homework as a guideline. It's posted, remember, under the materials section. Remember that what happens with a natural resource is that as it's excavated from its natural site, then what happens is the amount of you have to calculate first the depletion rate. Okay, and then that depletion rate is always going to be applied to the amount of that natural resource that is removed from the site that was recorded as part of plant, property, and equipment. Okay, and then all the ramifications that come from that, how long-term assets decrease, current assets increase, and how that's recorded on the balance sheet. Okay, and also how and when that inventory appears on the income statement. Okay, so that is an overview of what you can expect. Our midterm is Tuesday for an hour and a half. We won't, be having class for that last period of time, but we will obviously have class the following Thursday, and then we are going to continue with Appendix C, okay, which is the chapter on partnerships. Okay, when we end today's session, I will be posting Chapter 12, okay, on the exercises for Chapter 12 under the materials section for this particular chapter. And then I think just if I were you, I would spend the weekend. I would spend the weekend studying and going over the slides, rereading these chapters, going over all the exercises. Questions are going to look more like quiz. I don't remember offhand. It'll be a mix. It'll be a mix. Will we be able to skip? Yeah, you could skip it. Yes. you could skip it and you go back. But I think when you go back, it's going to be a different problem. Okay, just realize that because it's algorithmic. Okay, so the quiz is, I'm sorry, the midterm is going to look similar to like what your homework exercises were. Okay. All right, so everybody have a good weekend. First of all, the first thing you're going to do is register to vote. Even more important, go to register to vote. Remember, or mail in your ballots, whatever it takes. And then you're also, the second thing you're going to do is study for the midterm. Okay, and I'm going to go now to McGraw-Hill. Remember, the midterm is on McGraw-Hill. Okay, and I'll be posting that in the announcement section. The midterm is on McGraw-Hill, and I'll be opening up your quizzes so you can take a look at them and get your grades. Okay, are you welcome, Shamia? Good luck everyone on Tuesday.
Professor,
Yeah.
Did you get my email by any chance?
Yes.
Can we talk after class?
Yes, that's exactly, yes.
Okay, perfect.
Okay, very good. All right, you're welcome, Shamia. Everybody have a good weekend. Not too good though, study. Remember, all you have to do is study, right? You can't really go outside and have a good time. So invest in yourselves, okay? And have a good weekend and study. You're welcome. Have a good day, everybody. You too, Denise.